Welcome to the Deep Dive, the show where we really try to get under the hood of the big topics shaping our world. So imagine for a second you're looking at a company, maybe you're thinking about investing. You're poring over the numbers, right? Trying to figure out, is this stock actually a solid bet for the future? You're trying to predict its returns. And this isn't just something individual investors grapple with for, gosh, decades now. Financial researchers have been tackling this exact same question. It's like they've been trying to map this huge, unpredictable ocean of the stock market. They came up with these pretty sophisticated models, big theories like the capital asset pricing model, the CAPM, trying to find that sort of financial North Star. But here's the thing, these models, these maps, they often hit, well, some pretty big snags when you actually try to use them in the real world.
Yeah.
They didn't quite capture everything.
Yeah, and what's really interesting is just how deep that challenge goes. I mean, think about how incredibly complex a company's finances really are. It's not just the stuff you can easily see, the physical things, the factories, the machines, the buildings. It's also all that other dynamic stuff, like its day-to-day cash flow, how it manages its inventory, even the credit it extends to its customers. That's all part of the picture.
Yeah.
Now, imagine trying to take all that super detailed firm-level data. I mean, thousands of companies, each totally unique, and somehow boil it down into these big picture market insights. That is a massive task, a really huge challenge. And those earlier models, for all the smart thinking behind them, they often stumbled, especially when they tried to explain why certain kinds of stocks just consistently seem to outperform others. That's been a puzzle for, well, forever, for investors and academics. It was a bit like having this beautiful map that just couldn't explain why some ships always got there faster.
That sets things up perfectly. It really is a huge challenge trying to bring that messy, granular reality into a clean, predictive model. So our mission today in this deep dive is to unpack a really fascinating paper. It's called Aggregation, Capital Heterogeneity, and the Investment CAPM by Andre Gonçalves, Chen Xu, and Lu Zheng. We're going to dig into their pretty innovative approach, see how taking a much more detailed look at a company's different types of capital and using a frankly smarter way of combining the individual firm data, how that can dramatically improve our ability to predict stock returns, and maybe, just maybe, finally explain some of those market anomalies that have confused people for so long. So stick around. You're essentially about to get a shortcut to understanding what really drives investment value, hopefully with a few aha moments along the way. Okay, so let's start digging. To really get why these older models kept hitting roadblocks, we actually need to rewind a bit, like almost half a century. There was this economist, Stephen Nicol, back in 1978, who pointed out these major issues. He called them thorny problems, and they've been persistent headaches ever since for anyone building these models. These weren't just minor things. They were like fundamental challenges.
Absolutely. Nicol was incredibly insightful. His critique highlighted problems that are still, very relevant today. The first big one he identified was capital heterogeneity, which really is just asking, can we even aggregate? He seriously questioned whether it makes sense to just create these simple, broad buckets like total capital or total output for a whole economy, or even just a portfolio of companies. And then crucially, can you define a single meaningful production function? How inputs turn into outputs using those big blurry aggregates? His answer, for any realistic situation, was basically a hard no. What that means is firms don't just use one kind of capital, they use a whole mix of different things. And pretending they're all the same or just lumping them together, that's a huge oversimplification. It can really mess up your model. It's kind of like trying to understand a fancy meal by just adding up the weight of all the ingredients. There's flour, eggs, sugar, but you miss how they interact, the quality, the process. Aggregation just gives you a mushy average.
Right, so you lose all the important differences between, say, a factory and the cash needed to run it.
Huh.
Okay, so if we can't just lump capital together, what was the second big problem Nicol pointed out?
The second one was about the aggregation of relationships. So the question here is, even if you have good models for how individual firms behave, these sort of micro-level equations, how do you translate the rules, the theoretical restrictions from that micro level up to the aggregate level? It's really tricky, especially because those firm-level relationships are often complex, nonlinear. They don't just add up nicely. Just summing things up often means you lose critical information, you lose the nuance, you end up with that blurry picture again, even if you started with high-res data for each firm. Like trying to understand an engine by just looking at fuel in, exhaust out, missing all the internal workings.
Yeah, that makes sense. And the third problem he raised. This one sounds like something accountants and analysts still wrestle with today.
Definitely. It was measurement difficulties, specifically around investment and capital stock. I mean, how do you even accurately measure investment? Is it when the order is placed? when the machine arrives, when the bill gets paid, each choice gives you a different number, a different timing. And capital stock itself, for the total value of all the stuff a company owns, that's notoriously hard to nail down, especially for older assets. What's a 50-year-old factory really worth today? There's no active market for it. These aren't just small rounding errors. They introduce real uncertainty into the basic data we feed into the models. Your starting point is already a bit fuzzy. It's like trying to say exactly when dinner is cooked, when you mix it, when it goes in the oven, when it comes out. Those timing differences matter a lot in finance. Hashtag the investment in CAPM's prior struggles.
Okay, so these thorny problems weren't just theoretical worries locked away in academic journals, right? They had real-world consequences for the models people were actually using, like the investment CAPM, which, for all its promise, really bumped up against these exact issues.
Precisely. These weren't just abstract concerns. They had, and still have, huge practical implications. Those earlier studies implementing the investment CAPM, like the really influential one by Liu, Whited, and Zhang in 2009, they typically handled aggregation in a specific way that turned out to be, well, problematic. What they usually did was aggregate the firm-level accounting numbers, like investment rates, first up to a portfolio level. So they'd take a group of similar firms, average their investment rates, and then use that average to construct a portfolio-level investment return. Then they'd try to match that to the portfolio stock return. It sounds kind of intuitive, but it had some serious downsides.
Okay, what were the main drawbacks of doing it that way? Why didn't it quite work?
Well, there were two big interconnected issues. First, on economic grounds, doing it that way basically assumes that every single firm within that portfolio invests at the exact same rate, which, when you think about it, is just clearly not true. Imagine a portfolio of tech stocks you might have, a mature giant investing steadily, and a startup burning cash on growth. Treating them the same, it ignores huge real differences. It sort of forces this homogeneity that doesn't exist. And then, on econometric grounds, by averaging everything out first, you end up throwing away a ton of valuable firm-level detail, all that variation between firms. That actually contains really important information that helps you figure out the true underlying structure of the model. By smoothing it all out at the portfolio level, they were essentially tossing out data, losing the specific economic signals from each company, like listening to the general buzz of a forest instead of the individual bird calls.
Right, losing all that richness, smoothing over the very details that might hold the answers. And I remember reading about this parameter instability problem, which was like a massive red flag pointing to these shortcomings.
Yeah, you nailed it. That was a huge criticism, even pointed out in major textbooks like Campbell's. The issue was that these older investment CAPM models needed different settings, different parameters to explain each different market anomaly. Think about that. You'd calibrate the model to explain, say, why value stocks outperform, and you'd get one set of numbers for things like marginal product of capital or adjustment costs. But then if you wanted to explain momentum stocks, you had to plug in a completely different set of numbers. It's like saying gravity works differently depending on whether you're dropping an apple or a feather. That's a huge red flag. A truly structural model, one that's supposed to capture fundamental economic truths, should have parameters that are stable, or at least consistent, across different situations. This instability was a big aha moment, showing something was fundamentally wrong with how the model was specified. Like just looking at their numbers, the parameter for the marginal product of physical capital, gamma K, was like 16.6 for value stocks, but dropped to 12 for momentum stocks.
And the adjustment cost parameter A went from over 6 down to just over 1. Those are huge swings. It showed the model was having to twist itself into knots to fit different data patterns.
Okay, so we've got these deep problems. Tricky aggregation, lost detail, unstable models. If you're Gonçalves, Zhu, and Zhang looking at this, how do you start fresh? How do you actually fix this? What's their big idea?
Their core innovation is what they call a new exact aggregation scheme. It's a totally different way of thinking about it. Instead of the old method, aggregate the accounting numbers first, then calculate portfolio returns, they flip it. They first calculate the fundamental returns for each individual firm using its own detailed accounting data. So you get an intrinsic return for company A, then company B, based on their unique situations. Then and only then do they aggregate those individual firm-level returns up to the portfolio level to match the portfolio's stock return. This approach, which they lay out mathematically, preserves that rich, granular, firm-level detail that was getting lost before. All the unique aspects of each company contribute properly to the final picture. It's like building a mosaic tile by tile instead of starting with a blurry photo. Much more precise.
And a huge part of that precision comes from looking at different types of capital, right? Not just lumping it all together. They talk about two capitals. What are they, and why is that distinction so important?
Exactly. Most older models really just focused on physical capital, what they call KIT. That's the tangible stuff. Property, plant, equipment, PPE. Factories, machines, buildings. The hard assets. But the real game changer in this paper is adding working capital, or WIT, as a separate productive input. And this is absolutely crucial. Why?
Yeah.
Because empirically, when you actually look at company balance sheets, physical capital often makes up only about 38% of a firm's total capital, total meaning physical plus working capital combined. Sometimes it's as low as 18%, sometimes maybe 55%, depending on the industry. Table 2 in their paper shows this clearly. So if you ignore working capital, you're potentially missing like two-thirds of the company's productive base. It's like trying to understand how a body functions by only looking at the skeleton and ignoring the muscles, blood, organs. You get a very incomplete, potentially misleading picture. Hashtag tag the rationale for working capital as a productive input.
Okay, that distinction is really clear. Physical capital, working capital. But I can still imagine someone thinking, working capital, you mean like cash, receivables. How is that productive, like a factor? It feels more administrative, maybe. Can you really sell us on why it's actively creating value?
Oh, it's anything but just administrative. Working capital is absolutely essential for firms' operations. It's the lubricant that keeps the whole economic engine running smoothly, enabling the core business. Let's break it down. Think about cash. Firms don't just hold cash passively. They hold it strategically to avoid the hassle and cost of constantly having to raise funds or sell assets just to pay suppliers or employees day to day. Having cash on hand means they can seize opportunities quickly, maybe a cheap acquisition, or investing in urgent R&D without waiting for slow, expensive financing. It provides flexibility, agility. It's not just a buffer, it's an enabler. Then you have accounts receivables. That's basically trade credit when a supplier lets a customer buy now and pay later. This is a huge source of short-term financing, especially for smaller or constrained firms. Why do suppliers do it? It helps them boost their own sales. And often the supplier actually knows their customer's business really well, maybe better than a bank would. They might also be better positioned to, say, reclaim goods if the customer defaults. So it's a strategic tool for the supplier to build relationships and grow their market, effectively investing in their customer success.
Okay, cash for flexibility. Receivables is a sales tool. And inventory seems pretty straightforward, just having stock.
Well, yes, but inventory is also indispensable for efficiency. Holding the right amount prevents stockouts running out of product and losing sales, or running out of raw materials and halting production. That's incredibly costly. It also helps smooth things out. Imagine a company with seasonal demand. Instead of running their factory flat out for 3 months and then letting it sit idle, they can produce more steadily throughout the year, building up inventory for the peak season. This avoids burning out equipment, paying loads of overtime, and keeps skilled workers employed. It makes the whole operation more efficient. So yeah, working capital isn't just line items on a balance sheet. It's actively facilitating production, sales, and efficiency.
That paints a much clearer picture, definitely productive. Now, the model makes a simplifying assumption. No adjustment cost for working capital. Is that just for math convenience, or is it actually realistic?
It's partly for parsimony, keeping the model elegant, but it's also backed up by their own tests. They actually built a more complex version of the model that did include adjustment costs for working capital. And what they found, which they show in the appendix, is that those costs were mostly small and insignificant. Adding them didn't really improve the model's performance in explaining returns. So assuming no adjustment costs keeps the model lean, with just two main parameters to estimate, one for overall capital productivity, one for physical capital adjustment costs. Same number of parameters as the old physical capital models, which makes comparisons cleaner. It basically says, look, changing your cash levels or inventory isn't nearly as disruptive or costly as, say, building a whole new factory wing.
Okay, that makes sense. But given they added working capital, why stop there? Why not add other things that are clearly inputs, like labor or intangibles, like brand value or R&D know-how?
That's a great question, and they address it directly. It really boils down to measurement difficulties. Big ones. Working capital components, you can generally measure those pretty reliably from standard financial statements. But other inputs, much harder. Take labor. Wage data, which you'd use as a proxy, was missing for something like 80% of the firms in their sample. Trying to build a structural model with that much missing data is, well, basically impossible. And intangibles are even trickier. How do you put a precise number on brand value or organizational capital? You often have to make these ad hoc assumptions like assuming a fixed depreciation rate for knowledge or treating a certain percentage of SG&A expenses as intangible investment. Those assumptions themselves introduce a lot of potential error and subjectivity, which they wanted to avoid in this structural model focused on expected returns.
Their argument is that this lean to capital model, even without explicitly modeling labor or intangibles, does a remarkably good job explaining expected returns, which is the main goal here. They suggest that while things like labor and brand are crucial for a firm's total value, its overall market cap, the change in that value period to period, the expected return, might be more tightly linked to the more dynamic physical and working capital investment decisions. Hashtag the model's mechanics conceptually.
Okay, so we've got physical capital, we've got working capital, and we see why both are productive. So how does the model actually bring these together to calculate this fundamental return? Can we get the gist without diving deep into the math? What's the core logic?
Right. At its core, the model assumes the firm is trying to maximize its market value. Pretty standard assumption. To do that, it makes these ongoing decisions about physical investment, buying machines, building things, and about working capital investment, managing cash, receivables, inventory levels. The model then looks at the expected return on making those investments. For physical capital investment return, or get +1, it's a bit more complex because of those adjustment costs we talked about. It's basically the marginal benefit the firm expects to get next period from investing $1 more in physical assets now, divided by the cost of that investment today. That benefit includes several things. The extra profit from that asset, its marginal product after tax, maybe some reduction in future adjustment costs, tax savings from depreciation, and this thing called the marginal continuation value. That continuation value is basically the expected future value derived from today's investment. It connects today's decision to the long run. A key concept here is the shadow price of physical capital, or marginal Q.
Think of it as the market's perceived value of one extra unit of the firm's physical capital compared to its replacement cost. High Q means the market thinks investing more is a great idea. Low Q, maybe not so much.
Okay, that's the physical side. And the working capital return, you said that was simpler because no adjustment costs.
It's exactly. The working capital investment return, or WIP +1, is much simpler. Since there are no adjustment costs, the cost is just one unit of capital. So the return is essentially driven just by the after-tax marginal product of that working capital. How much extra profit does that extra dollar held in inventory or extended as credit generate? It's a more direct measure of its operational contribution. Now, the really crucial step is connecting these two investment returns to the firm's actual stock return, RSIT +1. The model derives a fundamental return, RFIT +1, which is essentially a weighted average of the physical capital return and the working capital return. This average is also adjusted for the firm's borrowing costs, after-tax cost of debt, ROE +1, and weighted by how much debt the firm uses, market leverage, WBM. The key thing here is that this fundamental return is calculated only from the firm's own characteristics, its sales, capital levels, investment rates, etc. It doesn't use market prices as an input. It's an internal, bottom-up measure of the return justified by the firm's fundamentals.
All right, so this new approach, exact aggregation, two types of capital sounds really powerful on paper, but does it actually work? Let's get to the results. How much difference did that exact aggregation piece really make compared to the old way?
A huge difference. The results really bear it out. Remember how those previous studies using portfolio-level aggregation struggled with unstable parameters and big errors? Well, these authors cleverly tested this. They took their own more sophisticated two-capital model, but then deliberately applied it using the old portfolio-level aggregation method just for comparison. And guess what? The pricing errors were larger. It clearly showed that how you aggregate matters immensely. It wasn't just about having two capitals. The aggregation method itself was a key part of the problem.
Can you give us a feel for how much larger those errors were? Put some numbers on it.
Sure. When they used their two-capital model, but with the old portfolio aggregation, the mean absolute alpha, that unexplained return you want to minimize, was about 1.5% per year when looking at value and momentum jointly. And the average absolute high minus low alpha, the error, in explaining the difference between top and bottom portfolios, was over 2.2% per year. Now, those might sound better than the really old models, but they were still significantly bigger than the errors they got using their preferred firm-level aggregation approach. If you look at the charts in their paper, like Figure 4 versus Figure 3, you can visually see it. With portfolio aggregation, the predicted returns are much more scattered around the perfect prediction line. With firm-level aggregation, things line up much better. It just confirms the firm-level approach is more structural, more accurate. It captures the real economics better, like moving from a blurry picture to high def. Hashtag the impact of capital heterogeneity, working capital's role.
Okay, so the aggregation method is critical. Got it. But what about the other big innovation, explicitly adding working capital? How essential was that part? Was it just a minor tweak, or did it fundamentally change the results?
Oh, it was absolutely fundamental. a total game changer. They tested this too. They ran a version of their model without working capital. So just a physical capital model, but using their new improved firm-level aggregation. And the results got way worse compared to their main two-capital model. The mean absolute alpha jumped up to nearly 2.5% per year. And the average absolute high minus low alpha, that shot up to over 7% per year. Much, much larger errors than their benchmark two-capital model produced. It really hammers home just how vital including working capital is.
Wow, 7% unexplained alpha is huge. Why does missing that one input, working capital, make such a massive difference in a model trying to predict stock returns?
It comes down to accurately describing the firm's actual operations. As we said, physical capital is often less than half the story, maybe only 38% on average. If you ignore working capital, your measure of capital productivity, usually something like sales divided by capital, gets severely misspecified if you only use physical capital in the denominator. The relationship between sales and just physical capital varies wildly across firms. Think software versus manufacturing again. It's a really skewed, dispersed picture. But as their Table 2 shows, when you look at sales relative to total capital, physical plus working, that ratio becomes much more stable and less dispersed across different firms. It gives a much more realistic view. So by including working capital, the model gets a much better handle on the firm's true underlying economics. Figure 5 in their paper shows this visually without working capital. The model's predictions are all over the place. The explained premiums look exaggerated. It struggles. Adding working capital brings things into focus. #, simultaneous explanation of the big four anomalies.
Okay, now for what feels like the holy grail in asset pricing. Can this new model explain the big, famous market anomalies, value, momentum, investment, profitability, all at the same time? And crucially, with stable parameters, because that's where the old models really fell apart.
This is exactly where the model truly makes its mark. It's a huge achievement. It successfully fits all four of these major anomalies simultaneously. You've got value, high book-to-market stocks beating low ones, momentum. Recent winners keep winning for a while. Investment firms investing less tend to have higher returns. And profitability. More profitable firms generally earn higher returns.
And the key is that parameter stability, right? After decades of needing different settings for different anomalies, what does it really mean that this model's parameters hold steady?
It's a massive win. It's strong evidence that the model is capturing something fundamental and structural about how firms operate and how markets price them. The core parameters, gamma, representing the marginal product of total capital, and A, for physical adjustment costs, they stay relatively stable, whether you're estimating them using value stocks, momentum stocks, or others, individually or all together. Looking at Table 3, Panel B, gamma only nudged from about 0.176 down to 0.134 across different tests, and A stayed within a range of roughly 3.7 to 8.1. That's way, way tighter than the wild swings we saw in the older models. It suggests the model isn't just curve fitting, it's describing a consistent economic mechanism that applies across the board. We might actually be getting closer to a unified explanation based on firm fundamentals.
And the bottom line impact of this stability and better fit, the pricing errors, the unexplained bits, they must shrink dramatically.
Dramatically is the right word. The improvement is really profound. When they estimated the model jointly on value and momentum portfolios, that average absolute high minus low alpha, the unexplained gap between the best and worst performers, was only 0.77% per year. Compare that to the over 7% error from the physical capital model using the same aggregation scheme. It's an order of magnitude smaller. Let's break it down for the specific anomalies. For the value premium, the model explained most of it. They predicted a 5.2% premium, data was 6.4%, leaving a tiny, statistically insignificant alpha of just 1.18%. Basically, the model accounts for it almost perfectly. For momentum, it predicted 14.6%, data was 15%, with an even smaller, insignificant alpha of 0.35%. Again, almost perfectly explained. Even when they threw all 40 deciles at it, value, momentum, investment profitability combined, the model held up remarkably well, as Figure 3 shows. The investment premium, for example, had a virtually zero alpha, a negative 0.06%. Now, technically, like almost all structural models facing complex real-world data, it gets rejected by a very strict statistical test called the over-identification test.
But that test asks for absolute perfection across every single data point, which is an almost impossible bar. The real story here is the massive improvement in practical explanatory power compared to what came before. It's getting the big picture, the core dynamics, right? Even if it can't predict every tiny wiggle.
Okay, this is super interesting. The model fits the data incredibly well. But how? What's the economic story? What are the gears turning inside the model that let it explain all these different anomalies at once without fudging the parameters? What's the intuition?
Right, this is where it gets really insightful. The model reveals this kind of dynamic tug of war happening within the firm. It's primarily between the firm's current investment decisions, its expected future investment, and its underlying profitability. Those are the main levers driving expected returns. It's not just one thing, but how these forces balance out. The key drivers, which they break down beautifully in Table 4, are current investment. This is about how much the firm is investing in physical assets right now relative to its existing physical capital base. What they find is that firms with low current investment tend to have higher expected returns. These are often your classic value firms. They tend to have a low marginal Q. Remember, that's the market's perceived value of adding more physical capital. Maybe they don't have great growth opportunities needing big factories right now. Conversely, firms investing heavily today, often growth firms, have high marginal Q, and the model predicts lower future returns for them, partly because the market's already pricing in that growth. The importance of this.
They show that if you artificially flatten out current investment across all firms, it generates a massive 36% alpha for the value premium. It tells you these differences in current investment are absolutely central to understanding value. And empirically, current investment is negatively correlated, natural 0.23, with book to market, fitting the story. Next period's investment, +1, KIT +1. This acts like the counterweight, the market's expectation of how much the firm will invest in the future. High expected future investment often signals high expected future growth, which can imply higher expected returns now. Next period sales to total capital, +1, KIT +1, WIT +1. This captures the expected future profitability or efficiency of the firm's total capital base, physical plus working. This is particularly important for explaining the profitability row premium.
Okay, so this tug-of-war framework, how does it specifically explain each anomaly? Let's start with value again.
Okay, for the value premium, looking at panel A of table 4, the story is that current investment, KIT, dominates next period's investment, +1, KIT +1. Low current investment, which is typical for value firms, directly leads to higher expected returns in the model. These firms aren't spending big on physical assets now. They have low marginal Q. The market might be discounting them for low current growth, creating the opportunity for higher future returns.
And momentum, which often feels like the opposite of value. Does the dynamic flip?
It totally flips. For the momentum premium, panel B shows that next period's investment, +1, KIT +1, dominates current investment, KIT. What's happening is that winners, stocks that have done well recently, are expected by the market to have higher marginal Q and invest more in the future. The market anticipates continued growth and investment from them. This expectation of strong future investment leads to higher expected returns today. The data supports this. Expected future investment is positively correlated 0.19 with past returns. They quantify this dominance. Fixing future investment expectations kills the momentum premium, creates a +20% alpha, while fixing current investment has a much smaller opposite effect, -7% alpha. It's all about the market pricing in that expected future growth for winners.
That's a really neat symmetry. Current investment drives value, future investment drives momentum. What about the other two, the investment premium and profitability?
For the investment premium, panel C shows it behaves similarly to value. Current investment, KIT, is again the main driver. Firms with high current investment, high asset growth, have lower expected returns. Why? High current investment implies a high current marginal Q, suggesting maybe the best opportunities have already been exploited or the market has already priced in that growth. So firms growing assets more slowly tend to offer higher expected returns. And finally, for profitability, the row premium. PAMD shows it's driven by a combination. Both next period's investment, +1, KIT +1, and next period's profitability, measured by sales to total capital, +1, KIT +1 WIT +1, are important. They reinforce each other. High profitability now, combined with the expectation that the firm will continue to invest effectively to maintain that profitability, leads to higher expected returns. The market rewards firms that are both efficient today and expected to stay that way.
That's incredible. It feels like they found this underlying engine, this interplay of current investment, future investment, and profitability that connects all these seemingly separate market phenomena. It's not just separate rules for value, momentum, etc., but one coherent story.
Okay, so the model absolutely nails the average returns, explaining the big anomalies with stable parameters and a clear economic story. That's huge. But what about, the relationship between the model's fundamental return and actual stock returns, like month by month or year by year? Didn't older models have a weird correlation puzzle here?
They absolutely did. It was a real head-scratcher. Often, older models showed weak or sometimes even negative correlations between their predicted fundamental returns and actual stock returns period by period, which makes you wonder if the model's even describing the right thing. A big part of that puzzle seems to have been a timing mismatch. Stock prices wiggle around constantly, but accounting data used in models comes out, quarterly or annually. It's like comparing hourly temperature changes to annual rainfall. The connection gets blurry. This paper makes significant headway in resolving that puzzle, mainly through better timing alignment. They cleverly compound stock returns over a 12-month rolling window centered around the measurement point to better match the annual frequency of the accounting variables driving their fundamental returns. And when they do that, they find significantly positive correlations.
Significantly positive. Can you give us a number? How strong is the connection now?
Sure. Table 6 shows the numbers. And individual firm level, the correlation is 0.11. At the portfolio level, it's higher at 0.19. Now, those numbers might not sound massive, but importantly, they are both statistically significant at the 1% level. That means it's highly unlikely this positive relationship is just random chance. It's a real connection. Plus, the lead-lag correlations are also interesting. At the firm level, fundamental returns predict stock returns positively for up to 12 months out. And at the portfolio level, that positive predictive power holds consistently for horizons up to 5 years, 60 months. That's a huge improvement over models showing zero or negative correlation. It suggests this fundamental return measure is genuinely capturing forces that drive stock prices.
Okay, much better than zero or negative. That's definitely reassuring. But, I mean, 0.11 or 0.19 is still a long way from a perfect 1.0 correlation, right? There's still a lot of noise or unexplained movement.
Absolutely. That's a critical point, and the authors are upfront about it. The correlations, while positive and significant, are indeed far from perfect. It means there's still plenty of variation in stock returns that the model doesn't capture. This could be due to remaining measurement issues in the data, or maybe there are other important factors, sentiment, liquidity, macro shocks, that aren't part of this specific structural framework. So it's a major step forward in linking fundamentals to prices, but it doesn't explain everything. The market is still a messy, complex place. Hashtag persistence of factor premiums, event time dynamics, figure 6.
Right. Okay, thinking about dynamics. Do these premiums stick around? We kind of know empirically that value tends to be a long game strategy, whereas momentum fades faster. Does the model capture these different lifespans?
Yes, it does, and that's another really strong piece of evidence for the model's realism. It successfully mimics these distinct event time dynamics, as shown in figure 6. It doesn't just get the average premium right, it gets the timing right too. For the value and investment premiums, both the actual stock return data and the model's fundamental returns show these are long-lived effects. The value premium persists for like 3 years or more after you form the portfolios. The investment premium lasts about 2 years. These are persistent advantages. But for momentum and row premiums, it's a totally different story. Both the real-world data and the model's fundamental returns show these premiums decaying much faster. They typically converge back towards zero within about 10 to 12 months. The edge disappears relatively quickly.
That's really cool that it captures that difference. What's the intuition inside the model for why some last longer than others? What makes value persistent but momentum fleeting?
It ties back again to that tug-of-war between current and future investment, particularly how it impacts the marginal Q dynamics over time. Figure 8.6 in their appendix gives a visual. When current investment, it-kit, is the dominant force, like in the value and investment premiums, the effect tends to be long-lasting. These reflect more fundamental, slower-moving characteristics of the firm's capital structure and investment posture. But when expected future investment, it plus one kit plus one, dominates, like in momentum and row, the impact is shorter-lived. This seems to reflect more transient shifts in market expectations or profitability that get priced in relatively quickly as new information arrives. It's more about near-term outlook than deep structural characteristics. Hashtag market states and factor premiums. Pro-cyclical, counter-cyclical, table 7.
Fascinating. Okay, one more dynamic. What about how these premiums behave in different market weather, bull markets versus bear markets? Do they perform consistently, or does the model capture any cyclical patterns?
It captures those cyclical patterns too, another impressive feat shown in table 7. It successfully reproduces whether these premiums tend to do better in up markets, pro-cyclical, or down markets, counter-cyclical. This is really useful for thinking about risk management. The value and investment premiums are both counter-cyclical. They tend to be stronger, offer better relative performance, following periods when the overall market has done poorly, down markets. For value, the model predicts a premium of over 17% per year after down markets versus less than 1% after up markets, using a 36-month look-back. That closely mirrors the actual data. 17% is 4.5%. So value tends to shine when times are tough. The investment premium also shows this countercyclical pattern in the model, directionally matching the data.
Okay, so value and low investment act kind of defensively. What about momentum and profitability? Do they follow the market trend?
It's exactly. Momentum and row premiums are procyclical. They perform better following periods when the market has been doing well, up markets. For momentum, the model predicts a 14% premium after up markets versus about 10% after down markets. This aligns really well with the data, where momentum delivers almost 20% after up markets, but actually loses nearly 10% after down markets. Those infamous momentum crashes happen in bad times. Row also shows this procyclical pattern in both the model and the data. Getting this right, especially for momentum, is a big deal. Older models often got momentum cyclicality wrong. The improved tiling alignment in this model seems crucial for capturing how these factors interact with broader market movements. It paints a much richer picture of how these strategies actually behave. #, higher moments and limitations. Table 8.
Okay, so the model gets average returns, lifespans, cyclical behavior. It's doing a lot right. But, no model is perfect. Where does this one fall short? What are its limitations? What does it not fully capture about market reality?
Right, it's crucial to understand the limits. And yes, despite its strengths, this model does have limitations, especially when you look beyond average returns, the extremes, what statisticians call the higher moments. First, it generally underestimates volatility. The fundamental returns predicted by the model just don't swing around as much as actual stock returns do. For example, for the momentum premium, the actual stock return volatility is a wild 28% per year. The model's fundamental return volatility, only 13%. That pattern holds across the board. The model's world is generally smoother than the real market. Second, and this is a big one, it largely fails to explain the negative skewness of momentum. We touched on this. Momentum strategies are known for these rare but severe crashes, big losses. That means the real-world return distribution has a long negative tail, negative skewness. The model, however, predicts a slightly positive skewness, 0.30, for momentum's fundamental returns, whereas the actual stock returns have a deeply negative skew, minus 1.78. So the model just doesn't capture that critical downside crash risk inherent in momentum.
And finally, related to that, it also tends to underestimate kurtosis, or fat tails. Real stock returns have fatter tails than a normal bell curve, meaning extreme events, big wins, and big losses happen more often than you'd expect. Again, looking at momentum, the stock returns have a very high kurtosis, over 11, while model's fundamental returns show a much lower kurtosis, around 5. It underestimates the likelihood of those really big market moves.
So it seems like the model is fantastic at explaining the typical day-to-day average behavior and the main dynamics, but those really sharp, extreme, maybe unpredictable market events like momentum crashes, those are still hard to capture within this framework. Does that suggest there's just a limit to what fundamentals can explain, or is it a sign that other factors, maybe behavioral ones, need to be added later?
That's the million-dollar question, isn't it? It probably suggests a bit of both. There might be inherent limits to how much you can predict, especially those extreme tail events that might be driven by sudden shifts in sentiment, liquidity crises, or other things not directly tied to a firm's quarterly investment decisions. But it also clearly points to areas for future research. Maybe incorporating behavioral factors or more dynamic macro variables could help capture these higher moments. The fact that this model gets the average behavior so right based on fundamentals is still a massive step forward. It nails the engine, even if it can't predict every single backfire or sudden surge.
Okay, fitting past data well in sample fit is one thing, but the real acid test, especially for anyone thinking about using these ideas, is prediction. Can this model actually forecast returns out of sample using data it hasn't seen before?
Yes, and this is another major strength of their work, something that really boosts its practical relevance. A lot of academic studies focus only on in-sample fit, but these authors went the extra mile and performed rigorous out-of-sample tests. What they did was construct expected returns for firms one period ahead. They did this recursively, meaning they'd estimate the model using data up to a certain point, predict the next period's return, then roll forward, add the new data, re-estimate, and predict again. It mimics how you'd actually use a model in real time.
Okay, and how reliable were those forecasts? Did the predictions actually pan out?
They found that the model's expected return estimates forecast subsequent returns reliably. There's a chart in the appendix, figure A12, that plots the predicted returns against the actual realized returns from this step-by-step forecasting exercise. And you see a pretty decent alignment. It shows the model holds up well when predicting the future, not just explaining the past. It suggests the insights are genuinely forward-looking and potentially actionable.
How does that predictive power stack up against other common approaches, like the factor models from Fama French that so many people use? Does this structural approach offer an edge?
That comparison is really telling. They directly compared their models' out-of-sample performance against popular factor models. And they found that, relatively speaking, the out-of-sample performance of factor models, such as the Q-factor model, is poor. Even the famous Fama-French five-factor model showed less reliable forecasting ability for expected return deciles compared to their structural two-capital model. It strongly suggests that this structural approach, trying to model the underlying economic engine of the firm, even though it's more complex, might actually provide more robust and reliable predictive power than factor models that just capture statistical patterns without necessarily explaining the why. Understanding the fundamentals seems to lead to better forecasts. Hashtag why this matters for you.
Okay, we've gone really deep here. Let's bring it back. What does all this mean for you, our listener? Whether you're managing money, advising clients, or just trying to be a smarter observer of the markets, what's the key takeaway?
Well, if you're trying to understand why stocks are priced the way they are, or why certain investment strategies seem to work over time, this deep dive really highlights something crucial. It shows that ignoring a company's working capital, the cash, receivables, inventory, or just relying on broad averages by lumping firms together can lead you to seriously misinterpret what's going on. You're missing a big part of the picture, potentially the most important part for expected returns.
So the bottom line is you really need to look closely at the company's actual investment decisions, how it manages both its big physical assets and its day-to-day working capital. It's about getting beyond simple labels like growth or value.
Precisely. The fundamental takeaway is that a company's investment decisions across both its long-term physical base and its short-term operational working capital are deeply fundamentally linked to its expected stock returns. And understanding that link requires digging into the details at the firm level, not just looking at averages. It's about appreciating the actual mechanics of how capital is deployed, physical and working. This structural approach gives you a clearer, more precise, and ultimately more reliable lens for understanding what drives investment returns, which hopefully helps you make more informed judgments. Hashtag tag outro.
And that brings us to the end of this deep dive. We've explored how a really careful approach to aggregation, looking firm by firm first, and a broader view of capital heterogeneity, bringing working capital into the picture alongside physical assets, can dramatically improve the investment CAPM. This model didn't just explain value, momentum, investment, and profitability all at once with stable settings. It also gave us real insights into how these premiums behave over time and in different market cycles. It feels like a major step towards a more unified understanding.
Yeah, this research really drives home that the details matter so much. In the often confusing world of finance, glossing over things like working capital or oversimplifying how we combine data can lead to models that just miss the mark. This work shows how getting more precise, taking a structural view, can bring real clarity to why stocks move the way they do, connecting prices back to tangible business decisions.
So as we wrap up, thinking about the power of this two-capital model, it leaves us with a question for you, our listener, to chew on. If getting a deeper handle on physical and working capital unlocks so much about expected returns, what other forms of capital, maybe less tangible ones like human capital, intellectual capital from R&D, maybe even social capital, the value of networks might eventually be woven into our models? Could those give us an even more complete picture of a firm's true value and potential? What do you think might be the next frontier in capital for understanding returns? Something to ponder.
Thanks for joining us for another deep dive. We hope this gives you plenty to think about. We'll be back soon with more insights.
Until next time, keep digging deeper.